Alrighty, folks. As we understand, last week I was in Las Vegas. We went there mainly for the multifamily wealth project hosted by the one and only Jonathan Twomley and his partner. So I thought we should talk to Jonathan. What were my takeaways? What were his? I'm sure they're probably a little bit different. But Jonathan, thank you so much for the opportunity to come out. We learned a lot, and yes, Olivia was there with me.
Yeah, for me, it was just a pleasure to finally meet you in person. That was great. And to meet Olivia and meet some of your crowd from ORAT. That was really great. I really enjoyed that. So that little morning session that we had on the second day of the conference was really fun. I'm glad I was able to stop by for that. So
yeah, thank you for that. They liked it. They enjoyed putting your face to a name as well. So thank you for that. So you were the host. You know, I've put on events before. I know when you're done, you feel like it's been a week. So what'd you think? What were your takeaways from the event?
Yeah, so gosh, we were obviously, kind of sweating bullets the whole time, right?
Sure.
Not only, on a whole bunch of different levels. On the one hand, like it costs a lot of money to put an event like that on, and we wanted to make sure that we didn't lose money or didn't lose too much money, and we managed to achieve that. But more importantly, like you put on an event like that and you want to make sure everybody has a good time, right? They get value out of it. And so that we were, obviously really worried about like what people were, how they were responding. And it's when you're up on stage and you're kind of like just trying to make sure that like everybody's where they're supposed to be. Like, is that speaker here? We had some issues with the hotel where they didn't put out, they were supposed to like mark the room for like the speaker seats and then the VIP seats, and they didn't do any of that for us. So everybody just came in and started sitting down. So it's like, crazy stuff like that. So I wasn't able to like really think about how it was going. But by the second day, once we'd kind of gotten over opening day jitters and stuff, and I started getting feedback from people, it was really, gratifying because people really, just the feedback I got was really positive, and ranging from like, I can't believe this is your first conference, you guys pulled this off, to like, this was great because it was all content and no pitching. Nobody tell me anything. And the content, the quality of the content was really good. So that's what we were going for. We wanted to have a pitch free, content rich, value laden event, and I think we pulled it off. So
no question, not a pitch to be had by anyone on stage. So that was very well done. One of my biggest takeaways, it was actually a panel that you hosted. I think it was the second one of the day one, where you had the debt and equity folks on stage.
Yeah, the debt and equity. So the capital markets panel.
Yeah. That was eye-opening, because I had understood them individually, but I never really put them together. So I think having them on stage together at the same time, because there's real pain across all of that. But when you understanding the moving pieces, there might be some deals to be had just for people that need to get out because of bad debt structures, bridge debt we've talked about a bunch. So I thought that was an eye-opening panel.
Yeah, so one of the interesting things for me about the panel was, and now I can't remember if it was that panel or the state of the markets panel before that, but there was a lot of overlap in what people were talking about. And one of the things that came out that I thought was interesting was that when you had people who were focused more on institutional level deals, they were basically of the opinion that like, there's not going to be a lot of opportunity coming. Not because there's not a lot of opportunity, but you won't see it. The market, it'll never hit the market. It'll be, the banks will quietly take over the loans, and then they're going to quietly sell it to somebody else. And you're never going to have a chance to like find out about this. It's never going to go to a broker, or if it does, the broker may be the one finding the buyers, but it's all going to be happening on the down low. And so, but then there are other people on the panel who are like, no, there's going to be a ton of opportunity. But when you dug into that a little more deeply, what was clear was like, well, yeah, it's sort of like the upper institutional level of stuff. It's all going to be handled like, very quietly, kind of like this. But at the lower levels where you and I are operating and where our listeners are operating, there's going to be probably a lot more distress and a lot more opportunity, therefore, for people who have positioned themselves to take advantage of it.
I agree. My takeaway from that session is there's a collection of 10, maybe 20 buyers around the country for trophy properties, trophy assets. Those aren't going to hit the wire. Those will go to Blackstone. Those will go to other huge operators. And there's, less than 50 of them, right?
Yeah.
They will get the phone call and say, hey, you're number 3. Do you want it or not? So that'll be hounded on the down low. But, if you step down, that's where we play. And it's going to be so much opportunity there, and really opportunity, frankly, to be creative.
Mm.
And, everybody wants to talk price, but maybe the right answer is just, deal structure, right? Maybe you absorb an institution's first, the seller gets a second at, 1%, you get a blended interest rate of, I don't know, 3.5, but now you inject some equity and you hold for longer term. So I think there's a lot of opportunity. Everybody wants to think price, that Houston property that got sold for whatever it was, 187, and the deal was 300, right? Huge wipeout. But maybe it's going to be creative financing or deal structure where the opportunities come.
I think, one opportunity, and I think this came up in the conference, somebody said this, and that so if you're a deal sponsor, right, you want to avoid a foreclosure on your record at all costs, because if you get foreclosed on, it's going to be years before a bank is going to lend you money again. So a lot of deal sponsors are going to be looking for ways to not get foreclosed on. And it may be the case, and this is where, the sponsors' interests are going to diverge from their LPs' interests, but it's going to be the LPs who take the hit, right? The sponsors are going to want to sell for whatever price they can sell to avoid getting foreclosed on, but that price may wipe out the equity, right? So depending on where interest rates go and how high they bought and all those different factors that go into, like, the difference in where they bought and where they're going to have to sell if they can't just extend to, was it survive till 25? Like that's the mantra,
that's the new saying.
So if you can't survive till 25, then there are going to be sponsors looking to sell. And so the way that you need to find these opportunities is to be networking with people who are sponsors. I think especially on the small end of things. So this is like perfect for this audience, right? Like for the ORAD audience who's looking, maybe to buy 10, 20 units, right? So
exactly.
I think there are some small syndicated deals out there that I'm always surprised to hear this, because I always grew up hearing like it's too expensive to syndicate a small deal, so you don't do it. But I've been hearing since then of like syndicated deals that are small, and I think some of those operators they're not well capitalized, right? They don't have the money to like put in the additional equity. Their investors most likely are not going to want to respond to a capital call. They're just going to be like, look, let's just walk away from this thing. But those operators, if they want to live to play another day, they're going to have to sell. So you can effectively do like a sub 2 for these, right?
Exactly.
We don't call it sub 2 in multifamily. We call it assuming the debt, right?
It's an actual assumption approved by the lender.
Yeah, this actually goes through the lender. It's not kind of like a little, I don't know that much about it.
It's not a side thing. Yeah, it's actually approved.
It's a little like on the down low a little bit, and the bank doesn't care because they get paid. But like an assumption is a formal thing. You have to go through the bank's underwriting and stuff. But assuming that you can put together a group of investors who have strong enough balance sheet combined, right? You may be able to go and just assume this loan for the, and get this asset for 75 cents on the dollar.
Yeah,
right?
for the debt. Yeah, exactly.
Yeah, and just by taking on the debt and not even putting any equity into it, right? So I think there are going to be some opportunities like this.
The other thing I remember from the conference, you actually brought up something that you and I talked about. I think it was 3 or 4 months ago on this channel. I shared my experience for one of my regional banks, saying, "Hey, Michael, after we did your statement, here's my file. We can't refi, half of these." And it was really interesting to see how the panel reacted, which basically said, yeah, that's going to happen. Yeah. There are going to be some operators that never missed a payment, have a great relationship, and the bank's going to be like, I need the cash.
Yeah. We talked about this before, and I gave you a shout out. I wanted to make sure to give you a shout out.
Thank you. I appreciated that.
So I brought up your story about banks, needing to rebalance their own balance sheets and having become very heavily weighted towards multifamily and wanting to, they may be forced to, right, by their credit committee to rebalance their assets. So they may wind up in a situation where they just don't refinance loans that are performing because they can't.
They can't.
Yeah. So they're going to be cherry picking the strongest operators and so there are going to be those opportunities too. It does raise the question of who's going to finance those deals though, right? Because if all the banks are in the same situation and they're all overweighted towards multifamily, I mean, I guess it's going to be private lenders or, non-bank lenders, or maybe there are some banks out there that didn't get into real estate as heavily. And now they're kind of the only, they'll decide, okay, now's the time. But I think it's going to be very interesting to see what happens with those. I mean, the banks may, let's just sort of do a thought experiment. Like if the banks don't want to finance them, but then they have to take them back and nobody else wants to finance them because they're all in the same situation, like what happens? You just wait around for cash buyers, I guess. And then there may be some real bargains, if that happens, where the banks at some point are like, all right, we're not going to get 100 cents back. We'll take 50. And
it's going to be wild. And I remember buying a multifamily directly from a bank. I think it was 2011. And they reached out to me. The bank reached out to me. They saw that I bought the building next door. They saw that I was improving it, right? So putting in real capital. And they called me. And I met the bank president down there on a weekend of all things. I remember it because it was like August and he's wearing a full suit. I'm like, why are you wearing a suit? It's a weekend. But I guess that's what bankers do. And we took it over for the debt that was on the building. We got their interest rate was reduced. And all we had to do was escrow 50 grand in repairs, which we would have spent anyway at the bank.
Right.
It was like, yeah, of course we'll do that. Right. So,
so the thing is, so one of my coaching students, so for whatever reason, I have a coaching program where I wind up with students who are like more experienced than me, which is great. Right. But, one of my students, we did our call last night and, he was saying, look, guys, you have to start, really deepening your relationships with your bankers right now. And he's like, if you're in business, everybody has a banker, right? You've got some person at the bank that's like your first point of contact that He said, start talking to those people and work your way up to the chain to figure out who it is who's in control of the real estate owned by the bank. Because you want to form that relationship now before this starts to happen. So that when it starts to happen, they're going to come to you because they're going to know, hey, you're the person who can buy this stuff, right? So it's a good thing to do, and I'm definitely going to start doing this myself. In the banks I'm developing relationships with, like in upstate New York and stuff, because those regional banks, right? I mean, those are the ones. If you're talking about sort of Fannie Freddie loans, I mean, they're going to go to a special servicer. It's very institutional, like. It's kind of like, how do you get to those people? There's many layers of people in between, to try to get to. It's a little harder. But for community banks, credit unions, like whoever it is that you're dealing with for your own banking, those banks have loans too for real estate. And those banks they're less well capitalized than these institutional, players. And they have rules where they have to keep some of this stuff on their balance sheet, and they're going to want to get it off their balance sheet if they have to take it back. So you want to be known to them now before this happens.
Yeah, I totally agree. The last thing to kind of talk about in this scenario is we're very early in this. I think lots of people in the room acknowledge that it's coming. It started, I can say that. The Houston example was thrown around a couple of different times. More other people responded. There's more behind that. But again, we're really early. We might be in the first inning, right? People can see it coming. Is it a tsunami? Is it just a big wave? Whatever that is. But this is coming, and it's going to be probably 18, maybe 24 months of opportunity / pain.
Yeah. And, the office market is going to affect everything too, right?
It will.
Because the banks, they're going to have to get capital from somewhere, and where are they going to grab it from, right? They're going to grab it from the assets that are performing. So, you could do everything right. And
Yes,
because the bank is
exactly.
having an issue with, with your office loans,
Yeah.
it could be a problem for you. But Michael, I'm curious, what other takeaways did you have from the conference?
So a couple of things I noted down is there's lots of ways to do this, right? We had some operators up there buying total junk, others buying assets. We had operator not syndicating, but still built a portfolio of 600. I thought was quite impressive. Um, you had different size of syndicators, right? The whole vocabulary that was shared was really why I came, because it's not where I play at all. Um, yeah, creativity was impressive. The stories, I love the close of day one. I forget the gentleman's name. He talked about locations, very data
Oh,
dependent.
Brian Burke, yeah.
Yeah, Brian Burke, he's
Brian
awesome.
Burke.
I had not heard him speak before. I thought he was extremely sharp, and he kind of plays the role of the, the, I don't know, the down luck guy or whatever, but he's clearly brilliant.
Yeah, Brian is
It's
a
a
brilliant.
stick.
Yeah.
Yeah. Then we go into day two, kind of the legal game and angle was good. It's just a whole eye-opening experience for both Olivia and I. We got what we wanted from the event. Just knowing there's different pools and different levels. That was my big takeaway. And I think I shared it on my daily financial news is there's so many levels to this game, right? And we were in a room where we were the small fish. And it was both uncomfortable, but it's what we paid for. So it was fun to see.
That's great. And just, I want everybody to know that we are going to do this again. So most likely towards the end of 2024, we're going to give ourselves enough time this time to like really do it right, sort of get the thing all set up, so we're not scrambling like we were this time. But keep your ears and eyes open for it. We will definitely be having some kind of special thing for listeners.
Yeah, think about that. Think about that. End of 24. Talk about great timing, right?
Yeah.
A year from now, we'll kind of know where we are. It'll probably be the fourth inning, maybe fifth inning. There'll be opportunity left, but there'll also be wins. There'll be stories to be told.
Yeah, absolutely.
Both good and bad. And that's great timing, I think.
Yeah, I'll be looking forward to Brian Burke talking about how he bought crazy great product at like pennies on the dollar. This flush with cash after selling everything last year. So that'll be fun to listen to. But I really hope everybody will come. Next time we had a great crowd from where at this time.
Yeah,
have more of you guys next time, and
that would be good. Very cool. Well, Jonathan, how can people follow you? You put on a great Facebook group, which more people need to join.
Yeah, absolutely. So come to Apartment Investors Club on Facebook, and just let me know that you're from the show. You don't have to, but I mean, it's always great to see from the show. So just drop it in one of the questions that you have to answer that you're from the show. Not the email question. Don't put it in there because it'll mess up the automation. But the other questions, please let me know that you're from there. And you can also go to I have a free download, which I don't have with me today because I'm home, but you can get that on my website, which is apartmentinvestorsclub.com. So go grab that download. It tells you how to syndicate a deal and all the steps you need to follow. So
very cool. Thanks, Jonathan.